Welcome to This Explainer. I'm so glad you're joining me today because we're going to unpack a seriously powerful financial tool for Colorado residents. If you're the kind of person who loves optimizing savings and, keeping more of your hard-earned money come tax time, you're exactly in the right spot. We're going to dive deep into the Colorado 529 tax deduction and build you a rock-solid, easy-to-follow playbook. Let's get right to it.
So, here's a real question for you. Did you know that you can turn your child's future education into a smart tax move today? We all know education costs are just continuing to rise, right? But the state of Colorado actually offers a pretty brilliant way to ease that burden, and it lowers your state income tax bill at the exact same time. This explainer is all about how you can leverage these rules to your total advantage.
To keep things moving, we've got a 5-step playbook today. 1. The Colorado 529 Advantage. 2. Eligibility and contribution limits. 3. Maximizing your tax savings. 4. Avoiding costly 529 mistakes. And 5. Claiming your tax deduction. Okay, let's dive into this. Section 1. The Colorado 529 Advantage and understanding the basics of College Invest.
So, a 529 plan is basically a tax-advantaged savings account that's built specifically for future education expenses. And here in Colorado, these are run through a program called College Invest. The core benefits? They are absolutely incredible. First off, your earnings grow completely tax-free at both the federal and state levels when you use them for qualified expenses. But the real game changer, and honestly the whole reason we're here today, is the state income tax deduction on your contributions. Plus, as the account owner, you keep total control over how the money is invested and who actually gets to use it.
Moving right along to Section 2, Eligibility and Contribution Limits. Who exactly qualifies for this? And how much can you actually save?
One of the biggest misconceptions out there is that you absolutely have to be the child's parent to get this tax deduction. Well, that is definitely not true in Colorado. Literally, any Colorado taxpayer can claim this deduction. We're talking parents, grandparents, aunts, uncles, heck, even family friends. As long as you contribute to a College Invest 529 plan and file a Colorado state return, you are good to go. It really makes this a fantastic tool for extended families who want to pool their resources together.
And this really puts into perspective just how generous Colorado's rules are. For the 2025 tax year, a single filer can deduct up to $25,400 per beneficiary. In joint filers, you can deduct up to $38,100. And it gets even better because those limits are jumping up for 2026, up to $26,200 for single filers and $39,200 for joint. And remember, that is per beneficiary. So think about it. If you've got 2 kids and you file jointly in 2026, you could potentially deduct a whopping $78,400 from your state taxable income, assuming, of course, you're in a position to contribute that much.
Now, there is an absolute ceiling you need to know about. The maximum lifetime contribution limit across all College Invest accounts for one specific beneficiary is $500,000. Yep, $500,000. Once the total aggregate balance hits that mark, you can't put any more money in. But, and this is key, the account can absolutely keep growing and earning those investment returns. All right, let's level up a bit. Section 3, maximizing your tax savings with some advanced funding strategies.
If you're looking to move some serious assets around, you've got to know about a strategy called superfunding. Superfunding is this really unique 5-year gift tax selection recognized by the IRS. Basically, it lets you drop a massive lump sum contribution into a 529 plan up to 5 times the annual federal gift tax exclusion amount, all in one single year. And the best part? It doesn't trigger federal gift taxes or eat away at your lifetime estate tax exemption. It's a total powerhouse move. Let's paint a picture here. Say it's 2026, and the federal annual gift tax exclusion is $19,000. Using that superfunding strategy we just talked about, a grandparent could drop $95,000 into a 529 plan for just one grandchild, all at once. But here's the crucial takeaway. While you totally avoid federal gift taxes on that entire $95,000, your Colorado state tax deduction for that specific year is still capped at the annual limit, which, like we covered, is $26,200 for a single filer in 2026. You can't carry that excess forward for state tax deductions in the coming years. But honestly, you're still getting the incredible benefit of years and years of tax-free compound growth on a huge chunk of principal.
Oh, and here is another fantastic strategy, especially if you happen to own a business or want to have a quick chat with your HR department. Colorado actually offers an employer tax credit. Companies can get a 20% tax credit, up to $500 per employee per year, just for making contributions directly to an employee's College Invest 529 account. It's an awesome workplace perk that helps keep employees happy while giving the business a really nice direct tax benefit. Moving into Section 4, avoiding costly 529 mistakes. We really need to talk about the differences between federal and Colorado rules. Now, what's really interesting here is the massive disconnect between federal and state tax laws. At the federal level, recent rules have actually expanded 529s so you can use them for K-12 private school tuition, student loan repayments up to 10 grand, and even certain 529 to Roth IRA rollovers. But, and please hear me on this is a huge but, Colorado has absolutely not adopted those federal expansions for state tax purposes. If you use Colorado 529 funds for K-12 tuition or paying off student loans, the state considers that a non-qualified withdrawal. And doing that, it's going to trigger state tax recapture and penalties. So, to keep your Colorado tax deduction perfectly safe, you've got to stick exclusively to higher education, trade schools, and registered apprenticeships. There are a few other common pitfalls you'll want to sidestep too. First up, the deadline. Unlike an IRA where you can kind of drag your feet until April, 529 contributions have to be totally completed by December 31st, no exceptions. Second, you only get that sweet Colorado tax deduction if you contribute to a Colorado College Invest plan. Out-of-state plans, they just don't qualify for the state deduction. And finally, just as a quick reminder, if you spend this money on non-qualified expenses, you are staring down a 10% federal penalty on your earnings. Plus, you're going to have to pay back the state taxes you already deducted. Nobody wants that. But hey, what if your kid decides college just isn't their thing? Seriously, don't panic. Unused funds do not expire. There's no forced age limit where you suddenly have to pull the money out. Plus, you can super easily just change the beneficiary to another eligible family member, think siblings, a first cousin, or honestly, even yourself. And you can do all of that without losing the account's tax advantage status. All right, Section 5, claiming your tax deduction. Let's break down exactly how you go about claiming this on your tax forms step by step. So, for anyone who files their own taxes, or if you just like knowing how the machinery works, you'll want to look for the Colorado Individual Income Tax Filing Guide. It's commonly known as the 104 book. It's the state's official guide, and it's got literally all the forms and instructions you or your CPA are going to need to get this done. And the actual process, it breaks down into 3 super simple steps. Step 1, make sure your contribution is completely processed and received by College Invest by that hard December 31st deadline. Step 2, when you're filing, find Schedule DR0104AD. That's the subtractions from income schedule. You just list your qualifying College Invest contribution right there. And step 3, you grab the final total from that AD schedule and transfer it straight over to line 8 of your main Colorado income tax return, which is Form DR0104. That subtraction is what directly lowers your taxable income. Boom, you're done. There is one really crucial administrative detail to remember, though. If you're a grandparent, an aunt, or a friend, and you contributed to an account that is actually owned by someone else, like the kid's parents, you have to fill out a secure, self-reporting gift contribution form on the College Invest website. This is what officially notifies the Colorado Department of Revenue about your contribution, so that your tax deduction actually gets validated. Okay, let's do a quick Savvy Savers recap to bring it all together. To really maximize this playbook, start saving early so you get all that tax-free compounding growth. Definitely maximize your annual limits based on how you file. Strictly avoid using these funds for K-12 tuition or student loans to dodge those nasty Colorado penalties. And finally, double-check that you or your accountant properly filed the DR0104AD schedule. Stick to this playbook, and you're well on your way to securing your family's educational future while optimizing your current finances. So I'll leave you with this thought. Are you ready to turn your education savings into your biggest tax advantage this year? The tools are right there waiting for you, generously provided by the Colorado Tax Code. All it takes is a little bit of structured planning. And as we wrap things up today, please remember, this explainer is for informational purposes only and does not constitute financial advice. Please consult with a financial advisor or tax professional for guidance tailored to your specific situation. Thanks so much for hanging out with me today, and happy saving.